And we're going to look at ways to use the information that we discussed in session number 2 last time, the income statement, balance sheet, and the cash flow statement, how we communicate the results of the company to the outside world and also within the company. First of all, we're going to talk about some key ratios we need to know, and the ones I've listed here are ones you should try to memorize for life. I've really kind of selected the ones that I've used across 4 different industries. When I worked in industry, every company I worked for used these same ratios, some more than others. So this allows you to look at which ratios are important and primary importance and which are maybe of secondary importance. There may be 40 to 50 ratios listed in the chapter, so we want to focus on the ones that are most important. We're going to break them into 5 categories. Short-term solvency ratios, the important ones you want to remember are current ratio and quick ratio. And we'll go over ways to not just memorize them, but to understand them. And we'll look for mnemonics to try and remember them, little memory devices that will help us remember these going forward. Long-term solvency ratios, we want to look at debt to equity, equity multiplier, also long-term debt to equity ratio. And with the debt to equity, if you have that ratio, you have 3. So we're going to look at ways to remember 1 and get 3 for 1. In the asset management category, we want to look at inventory turnover, days sales in inventory, days sales outstanding, and days sales in receivables. Total asset turnover to a lesser degree. In the profitability ratio category, we want to look at profit margin. And we're going to call that something different. We're going to call that net return on is preferable. A little bit easier to remember, and we'll develop a mnemonic for that. So net return on sales, net return on assets, net return on equity will be discussed in the profitability area. And then in the market value area, we're going to talk about PE ratio, heavily used in both industry and on Wall Street by analysts to measure companies' price to earnings success. Earnings per share will also be looked at, and market to book are 3 key ratios in the market value ratio area. So let's start with our 5 learning objectives. By the end of this session, you want to be able to understand what a cash flow is and the financial statement of cash flows as the most important of the 3 financial statements. How to standardize financial statements, so when we're comparing a large company and a small company, we can do that on a percent of sales or percent of asset basis. Third, we want to look at many of the key ratios that are used throughout industry and throughout the banking world. The DuPont identity is our 4th key learning objective. Why was the DuPont identity developed, and what is it, and are there any mnemonics for remembering it? And finally, how do we use all this financial statement information? We have lots and lots of numbers from the last session on the income statement, balance sheet, and cash flow, and how do we use this information to our advantage looking into the future? Learning objectives 1. Let's look at this cash flow identity. Remember from the last session, session 2, that cash flow in equals cash flow out. Cash flow out from assets equal cash flow to creditors plus cash flow to stockholders. Basically, that's what a company does. It spends cash and it produces cash. If it doesn't have cash, it quickly becomes a failure. So we acquire assets, we pay our bills, we pay creditors, we pay owners, and this is a use of cash. And hopefully we have higher sources of cash, which will allow us to do all of that successfully. In general, uses of cash are activities that involve spending cash, and sources of cash generate cash. In general, we're going to look for mnemonics again to understand what is a use of cash and what is a source of cash. This slide depicts it very well. A source of cash is a left side balance sheet item going down or a right side balance sheet item going up. For instance, if my current liabilities go up, that means I have bills that are unpaid. It's kind of a weird way of looking at it, but that's a source of cash. Conversely, if my left side balance sheet item goes down, if my inventory account goes down, that means I sold some inventory, and that's a source of cash. So left side balance sheet item down, right side balance sheet item up, those are sources of cash. Uses of cash are exactly the opposite. So if our left side balance sheet item goes up, we buy some inventory, that's a use of cash. So left side balance sheet item up, right side balance sheet item down, those are uses of cash. And that's an easy way to remember it, looking at the balance sheet. So what is a statement of cash flows? It's a financial statement that summarizes sources and uses of cash over a specified period of time. And again, this is probably the most important one because, again, at the end of the day, we have to be able to pay our employees. on whether it be the end of the week on Friday or the end of the month. If the payroll goes out once per month, we must have cash available to pay the. So the CFO carefully watches a statement of cash flows all the time. Again, these are prepared at the end of the month with the income statement and the balance sheet. And if you look at it over the long term, you find that statement of cash flows is just that. It's the income statement plus an adjustment for depreciation, plus any payout of dividends, and then plus changes in the balance sheet. And that dictates the amount of cash that goes up or down during the month in the firm. We break these today into three categories: operating activities, investing activities, and financing activities. And basically, we start again with last period's ending cash flow and look at net income. So the first line that comes into the statement of cash flows is net income right off the income statement. So it's critical. It points out the criticality of having a successful month or quarter or year in net income. If you have positive net income, everything kind of revolves around that, and that's a really good kickoff to your statement of cash flows. Beyond that, we will add back depreciation expense, and then we'll look at changes in the balance sheet. As I said, if receivables go up, as shown here, that's a left side balance sheet item. That's a use of cash. If payables goes down, that's also use of cash, and so on down the line. And so we pull these numbers directly off the income statement and the balance sheet, and we end up with a net cash flow of 14. We started last year with 84, and that might be 84 million. You have to watch your units, and we added 14 this year to show the end of the year cash flow at 98. Very, very important financial statement, the most important financial statement. It's one you have to keep your eye on at all times as Chief Financial Officer.